Investing in shares can be rewarding when you do your research, but it can also take up a lot of your time. With so much information out there, how do you quickly sort through the companies worth investing in and those to steer clear of? Skaffold is my research tool of choice. It tracks and reports on all ASX listed companies, plus thousands of global stocks daily, helping me decide which stocks to buy and sell. I can quickly filter through the reports to get the information I need. The rating system is like a set of traffic lights for the stock market. Green is good, orange is caution, and red is don't go any further. Skaffold's top stock choices have been highlighted for their outstanding performance by Money Magazine. With Skaffold doing the work for me, I have the confidence to make investment decisions without having to spend hours sifting through financial data. Now you can take control of your time and your portfolio. Why not take Skaffold for a test drive today?
Very good afternoon to everyone that's attending today. Welcome to Skaffold's second webinar for the year. And this webinar today is called How to Invest in Top Growth Stocks for the year 2015. It is with great pleasure. I would just like to introduce the two speakers. Most of you already know Roger. He is a co-founder and the founder of Skaffold and also Montgomery Investment Funds. And Chris Batchelor, who's our general manager at Skaffold and also a co-founder of Skaffold. And we want to ask you guys the first poll of today. So in your opinion, could you please let us know which industry sector you guys think is ripe for growth? Well, look, why don't we find out from the experts and we'll get straight into it. Good afternoon, Roger. Good afternoon, Chris. So firstly, let's start off with Chris. Chris, what do you look for in a growth stock and how do you find that in Skaffold?
What I'll do, I'll click on create a new filter and I'll start with the default one here, which is quality and growth. I'll quickly just give it a name. Now the first criteria that's already chosen there is the Skaffold score, and you can see we've got A1 through to B2. We want to focus in on the quality businesses, so we'll leave that in place. We've also got a debt to equity ratio of less than 100. That's more than we might sometimes use, but sometimes growth businesses do take on a bit more debt and that may be acceptable, so we'll leave that at less than 100. Now this one of course is key, forecast change in value, or another way of saying the growth in intrinsic value, and we'll aim for more than 8% with that. Now I'll add a few more to this. I'll start with the return on equity and I'll look at the forecast return on equity, and I'll aim for businesses here that have a forecast ROE of greater than 10%. So what I'm looking for there is businesses that are actually making a profit. So not so much your more speculative growth companies that hope to make a profit one day, but who knows when that day will be. Now I'll also pull up forecast EPS growth. You'll see here as I do this that there's lots of different metrics that you can filter on within Skaffold. I'll go down here to the forecast metrics trends and pull up forecast EPS growth 1 year. And what that's measuring is the change in EPS between the most recent historical year and the next forecast year. So if I apply all of that, you'll see that the universe shrinks significantly. And we're now down to 89 stocks. Now one final filter that I will apply here is not strictly a growth filter, but I'm going to apply a safety margin. I'm going to apply it very loosely, so around about minus 55%. But the idea of this is just to knock out any businesses that really are way, way overvalued. So once I've applied that, it should have a small impact. Yep, just a few more stocks knocked out. I'll save that. And now once you've done that, you can start to analyze and play with those stocks. Celgen, for example, is a biotech that focuses on cancer. Gilead is another biotech which has just found a cure for hepatitis C. Disney, I'm sure you all know Disney, and Apple and so forth, Visa. But what I'll do now is go back to the Australian market, because whilst there's a lot more growth opportunities in the US market, I imagine the majority of you are tending to focus on the Australian market. So what I'll do is I'll pull up that same filter for the Australian market, and what we can do nice and quickly is just click on this drop down, and that filter which I had saved will now be present. It should be. Oh yeah, of course, there it is right there. Growth stocks. It's present in that drop down list, and it's nice and easy to access. So you can see that's a smaller universe of stocks. We've only now got 35 stocks showing in the Australian market. We can also, of course, look at these stocks as a list, and I've pulled together a number of different headings for this particular stock list, but you'll see that I've included the sector and the industry so you can get an idea of what those are. And I've also included a few others which we'll come back to shortly. But what I might do now is just throw to Roger Montgomery and get him to tell us what are the things he looks for in a growth stock.
And welcome everyone, by the way, and nice to be joining you. The starting point for a growth stock is not necessarily the past. And in fact, it's not always the case that the past is a representation of the future, although we think it's often a reliable indicator of the future. If a company, for example, has a sustainable competitive advantage, then by definition we believe that the numbers that competitive advantage has displayed in the past is going to be sustained. And so we believe that it's going to continue. But that's the point. It's not in the data itself, it's in the identification of the competitive advantage where we find a company's ability to be able to grow its equity and grow its profits. So many people look at the numbers, and it's vital to do that. And that's what Skaffold does for us. It helps us isolate the universe of companies where we might find the thing that drives the growth. And the thing that drives the growth is this sustainable competitive advantage. So it was interesting looking at the survey results that we've just completed, and nobody thought basic materials was a growth sector, and most people thought healthcare, putting aside the fact that that's reflected in the prices of these stocks at the moment, whether they're expensive or cheap. The reality is that's not enough to determine whether or not a company is going to grow. Within each sector, you have to look for companies that have some competitive advantage. So that might be, for example, a monopoly position. It might be something we call or what's known as the network effect. And the network effect is this idea that people visit a website, for example, REA or realestate.com.au, also known as REA Group. People will put their houses on that site because more people visit that site. And more people visit that site because there are more houses on the site. And so you have this virtuous circle, this wonderful effect where a company continues to dominate and it becomes a winner-take-all scenario when everybody gravitates to the site that has the most product that they're looking for. What's important is a solid and consistent track record, not by itself, but because it indicates that the company might have something special going on that makes it a better company than its competitors. And if that's sustained, it will take market share, grow more profitably, and dominate its particular industry. So you have a look at Disney, for example, and Chris, you mentioned Disney just a moment ago. They have bought, for example, when you say the word Disney, the share of mind is enormous. And what I mean by that is when the word Disney is mentioned, people immediately think of Disney characters. You know, they immediately think of Mickey Mouse and Daffy Duck and Donald Duck, and your memories are almost intertwined with Disney cartoons. What might not be familiar or might not be well known to people is that they also own Pixar. They also own Marvel. So the Iron Man series of movies, Marvel comic movies, they own that suite of share of mind movies. And so this is what happens when you get a network effect when you get more people sharing stories with their children that are Disney stories because they're safe to read for their kids and they're not going to be surprised by double entendres and innuendo, then they tend to dominate, they earn more revenue, more people start going to those products, they can use that revenue to buy competitors, and it continues. So that's one of the indicators that we're looking for, a sustainable competitive advantage. And we ask the simple question, is this company going to be a lot bigger in 5, 10 or 20 years' time? Now, what I know is that most investors don't ask that question. And the reason why they don't ask the question is because the answer raises more questions requiring more work that people don't want to do. I'll give you an example. Let's take a company that manufactures the seats that we're sitting on today. Think about that company for a moment and ask yourself the question, do I think this business is going to be substantially larger in the future? Well, the answer to that question might include, well, I believe the population of Australia is going to double in the next 20 or 30 or 40 years. There's going to be a lot more bums on seats, therefore they're going to sell a lot more seats. Well, that's part of the answer, but it's not enough. What is going to stop the business from dominating? What is going to stop the business from going out of business? Because we know even in growth industries, there are companies that go out of business. We've seen that in aircraft manufacturing, we've seen it in locomotive manufacturing, in the manufacturing of televisions, we've seen companies go broke. Hundreds of companies go broke in the manufacturing of televisions. We've seen the same thing in the manufacturing of automobiles. So it's not enough that a company is growing, that an industry is growing for a company to grow as well. So you have to look, therefore, at the competitive positioning of the company. And this is where this slide, top-notch leaders, comes in, because it's really important that you've got leadership in an organisation that can actually drive the competitive success of a business. Realestate.com.au and carsales.com.au and Seek are benefiting because they got in early, they won the network effect battle, and now it's really just a question of time before they dominate and take all of the market share. But have a look at what's going on in those companies overseas and ask yourself whether they're replicating that success that they enjoy in Australia overseas. The short answer is they're not succeeding as well overseas as they are in Australia, and this comes down to management. If they're not able to replicate their success overseas, it's often because management are simply stretched too thin across the whole business, and the best return on their time is to devote their efforts to the local business that is going very well, because then they can attribute the success to themselves, and then of course they get paid more. And this is a very cynical view, but it's something when we talk to management we're very concerned about. We want management to be able to replicate success and repeat success. Now, how do you find a good manager? Well, of course, what you really want is a great business first, and that's why Skaffold's so useful, because we're looking for businesses with high rates of return on equity, little or no debt, that may indicate a competitive advantage. Then what we're after is good management to continue to drive that competitive positioning of the business to sustain those high rates of return on equity without the need for debt. But what's really important is that they can expand the business, because Australia is such a small economy. expand the geography of the business and the geographical reach of the business, and that really requires a track record. So we want a business that's good, that's high quality, with bright prospects, married to great management, but it's not enough to have a good business without the good management. First prize is both. So look at the history of the performance of the business to see whether or not management has been responsible. And here's the thing, a lot of investors don't do enough work on finding out how much of the track record of the business the current management was responsible for. So if the business has been a success for 20 or 30 years and management has only been in place for 2 years, current management, well, you need to ask yourself, how responsible are they for the past success? If they've been promoted from within the business, they could have been responsible for that success. But we're looking at Woolworths at the moment in a lot of detail because we think that its day in the sun is over, and we think its blue chip status has probably ended. And management comments in the media suggest to us that they really don't have a response to the Aldi threat at the moment, and management is really relatively new. There's even been talk about whether or not Roger Corbett would be brought back into Woolworths, maybe as a consultant to help them with their strategy. It's really important to go back over historical annual reports and have a look at all you need to do is look at the letters from management. So look at the letters that are written to shareholders each year from the managing director or the CEO and the chairman, and have a look at how often that's changed, and then have a look in Skaffold at the return on equity profile of the business and see which managers have been presiding over the business during the various business cycles that particular business might have experienced. So low debt, high return on equity, management with a track record. I should say this, good management in a bad business is not helpful. So it really doesn't matter who's managing an airline. The airline eventually will prove to investors that it's a bad business to own. And I'll turn back to Chris now.
Thanks very much for that, Roger. What I thought I might do is just add a little bit to what Roger was saying there and show you a few little tricks that you can use in Skaffold when you're looking to identify those growth stocks. Now, one of the stocks Roger mentioned was Seek, and you can see Seek coming up in here in our list of growth stocks. Now, a couple of metrics that I thought are just worth having a look at. I don't want to get too jargony on you, but there's just a couple of things that are worth looking at. One is this figure over here, which is the forecast earnings per share growth. Obviously, when you're looking for growth, that's a key number, and that is measuring the growth from last year to the next forecast year. So 20%, that's a really good growth figure. Now, this other number here, you may or may not be familiar with, but the forecast PEG ratio. And what that shows us is it's a measure of value for growth stocks. So the way it works is you take the forecast PE ratio and you divide it by the amount of earnings growth. And what you're looking for there is a number less than 1. So the idea being that stocks with a value of less than 1 are trading at a good discount to their intrinsic, trading at a discount to their PE ratio when taking into account the level of growth that's being factored in. So you're looking for less than 1, ideally, in that particular ratio. You can add and remove columns just by clicking on this Edit Columns button. So I've just pulled out a few columns that I think are relevant for this particular scenario, but you can change that according to your preferences. Now let me just go back to Seek. There it is there. And what I want to show you is on this particular screen, the summary screen, a particular summary point that is quite helpful. And that is that you can see here it says exceptional EPS growth is forecast. And if we click on that, it takes us through to the earnings chart where you can indeed see that from here, 2014, through to 2017, exceptional EPS growth is indeed forecast. Now, what's also good to note about this stock is EPS growth has been exceptional over 5 years. That's referring to over the past 5 years. So from back here through to here, and then forecast through to here, we can see that there has been very good growth profile of earnings per share for this business. That gives you a good sense that this is indeed a growth stock, and not only has it grown in the past, but it's likely to continue growing into the future. Why don't we just have a bit of a look at some of the sectors that might be ripe for growth? And I might throw to Roger. And Roger, we did the survey at the start, and people indicated that they thought healthcare was most likely to be a growth sector, followed by telecoms, and then a handful chose financial services. What's your view? Do you agree with that sentiment, or do you have a different view?
It's obvious to, I think, just about everybody that in the Western world, at least, we have an aging population. And so as a result of that aging population, the demand for medical procedures is going to go up, particularly in this generation more than any other. We're going to see an increase in the number of knee replacements and hip surgery, believe it or not. And that's because the baby boomers were the first generation to take up jogging as a pastime. And jogging over many, many years is actually quite damaging to the joints. And so, believe it or not, we're going to see a significant increase. There's also, of course, a greater incidence now of some modern or arguably modern diseases. There's believed to be an inordinately larger frequency of incidence of cancer, for example, arthritis, diseases related to the gut. Some doctors and oncologists believe that that's because of our disproportionately large consumption of wheat and modified wheat. Wheat's been modified a lot over the last 20 or 30 years just for broad acre farming, not talking about genetic modification necessarily, but there are consequences from that, and those consequences relate are going to benefit companies that are providing healthcare and diagnostic services as well as pathology services. So it's true that healthcare has enormous growth potential because of the aging baby boomers, for example, and the geographic spread of Western medicine into emerging markets where many, many billions of people have not had access. So that's another growth opportunity. But it's also true, it's also very, very true that there are threats to individual businesses based on new technologies. So that's one thing. And on the telecommunications side, well, I think that's an absolute lay down misere, and I really mean that. Not for every company, of course, but the amount of data that's going to be transported is going up enormously. So video usage is going to go up enormously. In fact, 2 years ago, it was only 46%. 2010 it was 46% of internet traffic. In 2010, 2 years ago, it was 53% of all internet traffic, and now it's up to 61% of all internet traffic, and it's actually going up at a rapid rate. Now, what does that mean? Well, that means a lot more data traveling through the pipe, so to speak, taking up more bandwidth, and it's happening constantly. So I love toll roads, a toll road business. It'd be great to be at a dinner party, and when somebody turns around and says, Roger, what do you do? To be able to say, I own the M2. The internet is like a toll road. The problem with the toll road is that cars go to sleep. People put their cars in their garage, they go to bed at night. The internet never goes to sleep. People now sleep with their phones by their side. They're always on. They've always got their Facebook account, their Twitter account, their LinkedIn open, and there are messages happening all the time. So the traffic is constant and it's going up. The businesses that are involved in laying down the pipe, businesses that are involved in storing the data, businesses that are involved in cybersecurity, and they're businesses that over the next 10 or 15 or 20 years are going to be infinitely more valuable than they are today.
So Roger, what do you think about basic materials? What's the outlook for basic materials?
Basic materials covers a lot of different businesses. The obvious one to talk about at the moment is iron ore, and iron ore was the top of everyone's mind. You might want to pull up a chart of BHP, a capital history chart from Skaffold of BHP. That would be useful. The iron ore price bounced from 2004 to 2011 it went up a lot, and that sounds like a really simple thing to observe, but it went from, I'll get this, it went from $20 a tonne to $187 a tonne between 2004 and 2011. And everybody thought they were going to be billionaires by just digging iron ore out of the ground and selling it to China, because China would never stop growing. They would never stop building cities. They would never stop building bridges and needing the steel and the cement and so forth for all of that. Well, guess what? They were building empty cities. They were building bridges that no one travelled on. They were building train networks on which there are no trains running. And this was all about keeping people employed and all about providing the infrastructure that may one day be needed when their constituents move from the rural parts of China into the urban parts of China. But those cities remain empty. And just as China was slowing down its demand for iron ore, Australian businesses and Brazilian businesses like Vale were increasing the production of iron ore. Now, here's another really interesting fact. For 30 years prior to 2004, the iron ore price traded between $10 and $20 a tonne. There's a possibility that, a real possibility that the iron ore price could now drop to those sorts of levels again. Have a look at this chart on Skaffold of BHP, and what you can see is that the profits for the company, if you go back to 2006, you can see the profit for BHP, the reported profit was 13 and call it 13.6, the normalised profit, $13.6 billion. And if you go out to 2015, the forecast profit is less. So we're looking at 10 years of no profit growth. And yet have a look at the grey columns there, which is showing you the equity invested in the business, and have a look at the red columns, the debt being lent to the company. And you can see that the debt has gone up, the equity contributed to the business has gone up, and yet the profits haven't grown. Now, I could take more money from a bank, and I could take more money from shareholders and put it in a bank account, and the only bit of equipment I would need is a rocking chair, and I could report greater profits. Now, Warren Buffett famously said on the subject of growth, he famously said, our job as investors is simply to purchase at a rational price, and listen carefully to this, a part interest of an easy to understand business whose earnings are virtually certain to be materially higher 5, 10 or 20 years from now. We simply can't be virtually certain that BHP's profits are going to be materially higher 5, 10 or 20 years from now. And that's why we're not interested in basic materials.
That's very insightful, Roger. Thank you very much for that. We had all our attendees vote for a stock that they wanted you and Chris to talk about today. So I might just pull up the most voted stocks for this webinar. There were top 3 were Flight Centre, REA Group, and Sirtex Medical. So I'm just going to ask all our attendees to vote for one stock. The results are out, and it's very close, Roger and Chris. And as you can see, out of the 450 people that are there right now, it's very split even.
Thanks for that, Shepard. I'm happy, and it's easy to talk about all 3 of them in some detail. The first one, of course, Flight Centre. Flight Centre is an interesting business because it often becomes cheap enough to buy. People believe that the Australian dollar is the ultimate determinant of the number of people who travel away from Australia and use Flight Centre as their booking agent. But that's not the case at all. The Australian dollar is declining, and yet the number of people travelling overseas hasn't diminished markedly. There was a slowdown in January, but it's picked up again, or numbers that came through in January that people booked flights in October, they were lower. But what we saw was we saw a pickup in November and December, and in the next few months we'll continue to see, I think, improving numbers, despite the fact that the Australian dollar is no longer at 101 or 102 US cents. So what is its biggest driver, and what should investors actually be focusing on? The price of seats to travel overseas. How much a flight costs. when the airlines get aggressive and start offering cheaper flights to travel overseas, that's when you find people going overseas. Nothing to do with the dollar, and that surprises a lot of people. Now, Flight Centre, if we pull up the value versus price chart, you can see that it's had an enormous run. So it was cheap. It was cheap when everybody was selling it because they believed that the Aussie dollar was the biggest influence, and it started to recover when people realised, hang on, I thought the Aussie dollar was going to be a detractor on its results. It's actually reporting that things aren't going too badly. And in fact, what's happening is that they're making small bolt-on acquisitions, which they need to do because they've got a lot of cash on the balance sheet that they need to employ at a high rate of return, and they're starting to do that. They're making some good acquisitions. Another company worth looking at. Go ahead.
Throw in a couple of comments there too, Roger. Listeners might remember that back in January, our Money Magazine article came out, and Flight Centre was one of the 5 stocks that we chose for that. Just quickly show you, this is that portfolio, which has now been running for 3.5 years, and we originally started that with $50,000, and you can see that it's almost doubled. And Flight Centre was one of those stocks, and indeed it's up, 38%, which is a nice little kicker. The other thing that I think is worth noting, though, Roger, and I'm interested to hear your opinion on this, but the traditional metrics that people look at when they're describing a stock as a growth stock, I don't know that Flight Centre actually meets them. It's a great business, and quick disclosure, I own it personally. But would you describe it as a growth stock, or is it more of a steady plotter, good business, but not going through the roof anytime soon?
Well, let's have a look at, thanks for that, Chris. Let's have a look at the capital history of this business. And I would describe it as a growth stock, and I'll tell you why. Notice that the return on equity 10 years ago, the return on equity was about 20%, and today it's about 22%. Now, if I could have a bank account that earned 20%, irrespective of how much was in it, so if I started it with $1 million and it earned 20%, but even if I had $50 million in it, it would still be earning me 20%. I think that's a remarkable growth stock. I think it's a remarkable growth account, and I want to own it. When you look at the share price, of course, invariably the share price goes through ups and downs, and you can see through the GFC, the share price dropped from $31.37 all the way down to $4.27. People were really, this sounds terrible, but we hope for another GFC because, I want to be able to buy Flight Centre at $4. I don't want to have to pay the price that it is today. I can see one of the questions that Tony's asked is about margin of safety as well. And he asked, what is margin of safety? Well, Tony, that's the difference between an estimate of intrinsic value and the price. So if the price is much lower than intrinsic value, you can see that here, then there's a large margin of safety. Right now, there's still a margin of safety, but it's much smaller. So short answer, Chris, I think that's a growth stock. So very quickly turning to Sirtex. Sirtex is a business that we own in the Montgomery Fund and the Montgomery Private Fund, and it's a business that I believe has very bright prospects. What does the business actually do? The business produces a medical device that is inserted into the body directly through the leg, and they're irradiated spheres that are a fraction of the width of a human hair, and they're irradiated, and they go directly into any tumours in the liver, and they deal with the tumours in the liver. That's the simplest way I can describe what they do. What happened recently was the results of a trial that the company has been running. It's the largest trial of its kind, came out, and the company had really attempted to move from what's called the salvage setting. And what I mean by that, and it's an unfortunate term, but what it means when all other cancer treatments on a patient have been attempted and nothing else works, and the patient is in a stage of terminal decline, then what's happened is some oncologists, an increasing number of oncologists have been using SIR spheres to prolong the life of those patients. And in fact, Sirtex has enjoyed, as a result of that adoption, Sirtex has enjoyed 44 consecutive quarters of dosage sales growth. And every year there's a conference called the ASCO conference, and the number of attendees to that conference has been going up, and at the session that Sirtex presents at, and the number of oncologists who have been saying that they're definitely going to use Sirspheres has been going up as well. But through this Sirflox trial, the company tried to move, or wanted to move, into what's called the first stage setting. And the first stage setting is really where there's a label change, and the FDA in the United States, the Food and Drug Administration, says, you know what, this should be approved for use as a standard of care, and then all oncologists would use this in addition to chemotherapy. So they might apply chemotherapy and then also apply Sirspheres. In order to get that first stage approval, if you like, or the standard of care label from the FDA in the United States, they would have to have shown overall survival. So even if a patient had cancer in the liver but cancer elsewhere in the body, then the administration of Sirspheres would have to show that it increased the longevity of the patient, even if cancer was riddled throughout their bodies, as unfortunate as that is. They weren't able to show that in the trial. And so the share price slumped from $34 to something like $14 or $15. And you can see that if we expand on that here, that's a closing price of $17.53. It got down to less than $15 during the day. And we were a buyer of that stock because the first prize was overall survival, which they didn't get. Second prize was showing progression-free survival, what's known as PFS, in the liver. So, and they did show that. But it wasn't until the ASCO conference last week or the week before where they were able to show whether that was statistically significant. But how significant was it? Was it patients survived a day extra? If they only had cancer in the liver, was it a day extra that they lived, or was it a month extra or 2 months? Well, it was almost 8 months of progression-free survival. Now, what that does is it actually means that oncologists who are administering Sirspheres in the salvage setting are more likely to do that, and that will increase their dosage sales in that salvage setting. So we think that the business's value has gone up as a result of that, and that's why you've seen the share price rise dramatically. And what's interesting is that during the day, you'll see here the bullish intrinsic value for 2014 was, because this company reports at the end of the calendar year, $14.41. And on that day, the share price got very, very close to that intrinsic value. And so Skaffold really did a great job of keeping people out of the risky danger zone when the share price was up at $34 and so forth, and really made sure that they were only interested when the share price dropped. In a few more minutes, one of the companies that I wanted to just highlight for everyone to go and research, which I think is a business that has enormous potential, and this is a business called Isentia. Now, it's only been listed recently. However, it's a business that's been around for 32 years in Australia. It's the old media monitors business. If I was let's say a media personality, and I wanted to track all the mentions of me in the newspapers around Australia, on radio and on TV, then I would employ media monitors or Isentia to collect that information for me and tell me where I appeared. Here's the really interesting thing. Just from that business, it's grown to 90% market share in Australia. And what's even more interesting is that because of social media now, Facebook, Twitter, there's Snapchat, and there's YouTube, the number of places that Isentia has to actually go and find where you've been mentioned has increased phenomenally. And so as a result of that, the number of people using Isentia goes up because they can't do it all themselves, and the amount that Isentia can charge goes up because they've got more places they have to go and search for this information. But they give you a whole bunch of analytical information related to where your name's been appearing, and they will let the company know that now is the time to respond in the media and get on the front foot. So this is valuable information for the company. Now, they're growing in Asia. They've got 28% market share in Asia, 5 times more than their greatest rival, and their top 50 clients around the world have been with them for 11 years. So they're not leaving. Now, very quickly, show a couple of quick slides. Have a look at the numbers here. They are very impressive sales growth numbers, EBITDA growth numbers, and NPAT growth numbers. Look at that, 508% in 2012, a slight decline in 2013, but and that was related partly to a restructuring, but 70% growth in 2014, 66% NPAT growth in 2015. And if you look at the incremental margins down the bottom, and this is where we look at the change in margin versus the change in revenue, you can see they are so attractive, those numbers. They're double-digit, high double-digit numbers, nearly 100% numbers. So an incredibly attractive business with what we think are very bright growth prospects. And this is a really telling chart that comes from the company's briefing to analysts, which you can find through Skaffold in the announcements area. And you can see this is average revenue per customer or client. And what this is saying is not only is the company attracting more clients, but the amount of money each client pays the company is going up as well. So think about the best business. I mean, most companies, when they raise their price, they sell less product. This is a company that as it raises its prices, it earns more per customer. The number of customers it serves goes up. Well, that's fantastic. Two other questions that we can answer. Lester asks, what do you think of agribusiness as a growth opportunity? I think that's very, very tough, because even if you get the commodity right, even if you get the wheat price right, or you get the canola price right, or you get the pork bellies price right, or the live cattle price right, the agribusiness might not make any money because of drought or flood or pest. And even though the commodity price might go up, the business might actually miss out on that opportunity because of acts of God, so to speak. Greg asks, retail stocks, especially the Reject Shop and JB Hi-Fi, still growth stocks? Look, Greg, I spoke to a very good friend of mine who is a very large shopping centre owner in Australia, and he tells me that unless you're selling hot chocolates, cakes, chocolate, gourmet chocolates, or other foodstuffs such as Asian takeaway, everyone seems to be suffering. Reject Shop, JB Hi-Fi, I think they're going to be challenged in terms of strong growth, but when they're very cheap, and see what's happening now, of course, is that the share prices for these companies have gone up because the government has come out and said in the budget that you can buy as many $20,000 products as you like for your business, and you're going to get a significantly more attractive treatment through your tax return than you would have previously. And as a result, a lot of people believe people are going to buy $20,000 worth of plasma tellies, and JB Hi-Fi is going to benefit. There's some truth to that, but it won't mean the company's going to double, triple, or quadruple its profits over the next 5 years. The question that comes up, another question just popped up. Isentia is a C2. What we know is that that's partly the result of the legacy and the changes as the business went from being an unlisted business to a listed business. And what you'll actually find is that over time that debt will be paid down very, very quickly, and it's a function of a restructure. So we look forward and we ask ourselves, how much cash is this generating? Look at the cash flow in in future periods for Isentia, and ask yourself, if they wanted to devote this cash to paying down the debt, how quickly could they pay that down? And you'll quickly find that the quality rating will start to improve. Remember, we're looking forward. We're not looking at the past, we're looking forward. It's important to read the prospectus when a company lists and understand the restructuring that's gone on in a business to arrive at some of these balance sheet issues. Marcus asks, everything looks to be overpriced, what should I do? Well, actually, what you should do is use Skaffold to look for opportunities every day, because even though the market was expensive, a company like Sirtex became fair value, and then it went from $14 back to $30 in the space of a few months. And you know, there was an offering there of 100% return potentially, and it's not that potential. We bought the stock on the day that it dropped, and so there are always opportunities even in an expensive market. And so the important thing is to keep your eye on those opportunities. What's going on with Medibank? Richard, we believe Medibank's future is bright. We could be wrong on that. But we believe it's bright, and we own the stock, and we're going to continue owning it. So for us, the only thing that's going on with Medibank is that the share price has gone down. There's some concern that in the short term, there's going to be some pressure on their margins and pressure on premiums. That could be true, but that could be an opportunity rather than a risk. Another one is the healthcare sector overvalued and due for a correction? The short answer is yes, it's overvalued or overpriced, but that doesn't necessarily mean it's due for a correction. And the last one, PEG ratios, do we use them? No, and the reason why we don't use them in isolation is because, quite simply, what we've noticed is that when we've done our algorithmic testing, our back testing of PEG ratios, they don't seem to work. And I know Peter Lynch was a big fan of them, and he said that he used them, but there's a lot of research that shows that, you know, on a purely quantitative basis, they don't work on their own. You really should focus on quality businesses trading at a discount to intrinsic value with bright prospects, and Skaffold is uniquely positioned to help you do that.
Great, thanks, Roger. Look, unfortunately, we have run out of time, but I would like to thank Roger and Chris for today's insightful webinar. Thank you very much, everyone, and we look forward to speaking to you in the next webinar.
Investing in shares can be rewarding when you do your research, but it can also take up a lot of your time. With so much information out there, how do you quickly sort through the companies worth investing in and those to steer clear of? Skaffold is my research tool of choice. It tracks and reports on all ASX listed companies, plus thousands of global stocks daily, helping me decide which stocks to buy and sell. I can quickly filter through the reports to get the information I need. The rating system is like a set of traffic lights for the stock market. Green is good, orange is caution, and red is don't go any further. Skaffold's top stock choices have been highlighted for their outstanding performance by Money Magazine. With Skaffold doing the work for me, I have the confidence to make investment decisions without having to spend hours sifting through financial data. Now you can take control of your time and your portfolio. Why not take Skaffold for a test drive today?